Hi, everybody. Just before we get started here today, I just want to make sure everybody can hear us loud and clear. So those of you that are on a computer and able, if you don't mind just typing something in the chat box just to let us know you can hear us okay, we will go ahead and get started shortly. Awesome. I'm starting to see a few folks respond. So thank you guys for doing that. Awesome. Cool. Thank you guys. So we'll go ahead and get started. So hi, everybody. Thank you all so much for taking the time to be on this webinar this evening. I am really looking forward to having our colleague Dmitry Fomachenko from Sense Financial go over the value of self-directed retirement accounts with everybody. It's a pretty unique timing because shortly after I started with Marshall Reddick, I attended a presentation just like this on self-directed retirement accounts. And I took so much valuable information from it that immediately after that presentation, I reached out to Dmitry personally and set up my own solo 401k. So I'm happy to announce that just over 2 weeks ago, I actually closed on my first real estate transaction within my solo 401k. And super excited to be going over this with all of you guys, as it's something that's very fresh in my, my personal experience. So yeah, great timing on this. Okay, so a little bit more about myself. So my name is Vince Tomich. I'm an advisor here at Marshall Reddick. And my primary role as an advisor is to learn as much as I can about each individual investor to help guide you through the process to achieve your investment goals. So I was born and raised here in Southern California. I've been in the real estate industry for over 5 years now. As I mentioned in the beginning of the call, I personally invest in rental property. Prior to my role as an advisor, I was a mortgage lender for a number of years. And that's where I really learned the value of leveraging money. I realized that investing in my market, which is Southern California, was very difficult. But when I was introduced the idea of investing out of state, coupled with understanding financing, is what made the goal of investment property very real. So I was really happy to be in a position to link up with Marshall Reddick and to be able to get connected with folks in multiple markets and get personally involved. So I'm sure many of you have attended our webinars or seminars in the past, but for those of you that are new, this is always a good opportunity for me to explain, who Marshall Reddick is as a company and what we do. So we're a full service real estate firm, and we focus on 3 primary services: real estate brokerage, property management, and private lending. So for our real estate brokerage, we help people buy and sell property, whether it's a primary residences or investment property, whether that's here in Southern California or in one of our markets across the US. 99% of the folks that end up buying an investment property are going to need property management. So we handle everything from A to Z there. So that goes from marketing the property, taking photos, walkthroughs, rent collection, rent disbursement, any kind of maintenance request. So we would handle everything from A to Z. We would also take care of all of your year-end tax documentation and make sure we're giving those to you so you can pass that to a CPA. So that's really important. And then our final service is private lending. This is a really unique niche part of our business. And we actually have 2 clients for this. So we have our borrowers and then we have our lenders. So let me give you some example of borrowers. So borrowers are folks that are our typical borrowers are people that are looking to do fix and flips on a home, who maybe can't qualify or won't qualify for conventional financing. Maybe those folks that have over 10 financed properties, they need private lending, or as it pertains to this presentation, folks that have self-directed retirement accounts. So those that want to acquire property in a self-directed retirement account need what's called a non-recourse loan. So that is what private lending offers, is a non-recourse loan so that you can bridge the gap between your down payment and the purchase price of that property. Those are good examples of our borrowers. On the flip side of that, we have lenders. So the same way you can invest in property, you could also invest in first position mortgages. So you can be the bank, you can loan money to these folks that I was just mentioning. Those returns go anywhere from 6 to 12%. We also have our mortgage fund, which is something that a lot of our investors are into. And you can invest into those types of vehicles through self-directed retirement accounts, which again, we will be going into great detail today. So, my goal is to make the process of investing as seamless as possible by educating and introducing the key players that work with us to make this a reality. Now, a little bit more about our markets. So we are located in 16 different markets across the country. You're going to see here that some of these cities are outlined with a green box, and that is where we actually have a physical location. So that means we have our own real estate agents, our own property management team, our own relationships with vendors. These are, the markets, like I said, that we have a physical presence in. The ones that are not highlighted, we have resources. It's more of a referral type of system. But ultimately, if there was interest in any of these other markets, we do have the ability to get you connected with the proper folks. Before I turn it over to Dimitri, I'd just like to go over, how we've chosen to invest in some of these markets. So we've taken the time to vet out specific markets we want to focus on. And, I think we can all agree that not every market across the US is a good market to invest in. So we've put together some key criteria that we feel support strong investment markets, and that includes, what you see on the screen here. So, strong job market, low vacancy rate, you want economic diversity, affordability, right? You want these prices to be reasonable. Landlord friendly is important, strong education, and then of course, you want to have access to reliable property management. Those are all, key factors of how we've chosen some of these markets, and they definitely, the markets we're in, check these boxes. So that's kind of the extent of, I guess, my intro to who we are. Next up, I want to bring up Dmitry Fomachenko, who is going to be talking to us about our self-directed retirement account. So I will go ahead and kick it off to him and let him take it away.
Vince, thanks so much for putting this webinar together. Can you hear me just fine?
Yep, hear you loud and clear.
Okay, awesome. Well, thanks again for the honor to join you presenting this topic. It's always exciting, but I just wanted to piggyback on what you said. I've been involved with Marshall Reddick for probably good 15 years, and it's pretty exciting to see how the company evolved from what it was back then to really a full service, which is pretty exciting. Those investors that are taking advantage of your services now is it just you provide so much value. But just a little bit about myself. You have my contact info here, so feel free to jot it down. I'll share this slide again towards the end, we might have some questions, some time for questions towards the end, so you can ask any questions later, but you can also reach out to me directly for specific questions that you may not want to ask here publicly. Okay, so what we do is we basically, our mission is to help our clients obtain, control, and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity, and we want to come along your side and help you build that wealth by providing you certain tools that will aid you in those goals. Before I jump into my topic, I just wanted to give you an example. I think that can look as a financial makeover or a 401k makeover. You've seen those makeovers, the home makeover and things like that are on TV out there. So I think that's a good comparison. So this is Jason. Jason is our client in Tallahassee, Florida. He found us. He's pretty old now. Old client. I'm talking about maybe 6-7 years. But he found us online, contacted us. He had a couple different retirement accounts, valued at about 135,000. He was losing money in the stock market. Was concerned, frankly, about the safety of his retirement funds with the ever-growing government debt. He was concerned that the government may be after a private retirement account. So he was looking for a solution, Googled, found us, contacted us. I personally spoke with him, and we were able to set up a self-directed solo 401k plan for him. And he invested in a rental property. Portion of his solo 401k was invested in his brother's private business. And then the remaining portion he actually used to lend on a real estate note. So essentially his 401k became a bank. And collectively he's receiving over $1,000 a month in cash flow. So if you compare the situation he had before, where his account balances actually were going down because of the uncertainty of the stock market, he didn't really have any collateral and any it was just the paper investments, essentially stocks. But now he owns physical assets, and he is able to see his 401k growing every single month, because real estate note generates interest income every single month. The rental property he owns inside of his solo 401k generates rental income every single month, and also it appreciates, and he already experienced significant appreciation over those few years. So I'm going to show you three options today, three options that are out there if you wanted to self-direct. So there is a custodial self-directed IRA, there is a checkbook IRA, and there is a solo 401k, and we'll talk about each one of those options. But before we do, just a quick comparison of what the conventional retirement account looks like. If you have an IRA or 401k with your employer, it is controlled by the custodian. And the custodian is the one who actually limits or dictates your investment choices. And typically your investment choices are always confined to the stock market. So you may be able to invest in some stocks, bonds, and mutual funds. Here is an example of a page that I received when I actually was working, and I had a 401k with my former employer. The representative will come up and meet with us maybe once or twice a year, will give us a similar sheet, and those were our investment choices. It's pretty much it. As you can see, very limited. Well, with the self-directed, you have essentially unlimited investment choices. You can invest in residential real estate, tax liens, tax deeds, cryptocurrency lately been popular. You can, as I mentioned, my client did, you can invest in mortgage notes and trust deeds, be the bank, and on and on and on. So these are just some examples of the most common investments, but the list goes on and on and on. I'll tell you about the limitations, what you cannot do, which is essentially just a couple of things you need to be aware of. Other than that, you can literally invest in anything that you want. So pretty much unlimited freedom and control. So what is a self-directed IRA? Essentially, it is a tax-deferred trust account that was designed to help people like you and I save or put money away for the retirement. It is held with the IRS-approved custodian and allows you to invest in non-traditional assets. Majority of people out there still not aware of existence of self-directed IRAs. There could be different reasons why. Perhaps your stockbroker obviously is not interested in explaining this to you because they make money off of you invest in, and they might be even tell you it's illegal. However, it's definitely possible you can do that. This account's been around since 1974, and millions of people took advantage of this. So you can as well. So how does it work? I put together this diagram just to kind of help you visualize this. Step number one, you need to open a new account with the IRS approved custodian who will allow alternative investments. Step two, you will make qualified transfer. A qualified transfer means that you don't touch the money, the funds go directly from your existing custodian to the new custodian. So it's not a taxable event. So it's a qualified transfer, and you can take your existing IRA, 401k, 403b, or any other qualified retirement plan and move it into a self-directed IRA. Just to comment, any IRA can be moved if it is an employer-sponsored plan like a 401k or 403b. Typically, if you're still employed and have a 401k there, you will not be able to touch those funds until you leave the employer or reach a retirement age. There could be exceptions, and you may want to check with your employer, but generally, as a rule, former employer retirement plans can be moved with the current employer not. Well, next, you as the account owner, you direct the custodian. So essentially, custodian have custody of your account and all of the assets, but you tell them what to do. So you can tell them, hey, you would like to invest in this rental property, or hey, you would like to fund this real estate note. And you contact them and you authorize the investment, and they make the investment on behalf of your IRA. Obviously, the advantages are unlimited investment options, but the disadvantages is fees. Every time you make a transaction, you make investment or pay the expense and so forth, the custodian will charge you a fee. They're in the business to make money, and that's how they make money. Some people also find that going through a middleman is very inconvenient. It causes delays. There's a lot of red tape, and they look for alternatives. And so essentially the next option, which is called the Checkbook IRA, is that option. It's also known as IRA-owned LLC. There is a special purpose LLC created. This LLC is owned by the IRA and it is managed by you. It does require a special IRS compliant setup and operating agreement to be in compliant with the IRS. But this structure allows you to bypass the custodian when you make investment and transactions. So essentially, you can't avoid the custodian completely. With an IRA, custodian is required, but you can bypass the custodian and you can pretty much eliminate all of the transaction fees. There is a nominal fee that you pay to have that IRA open, but no transaction fees. So how does it work? The beginning portion is similar. You open a new custodial account with the IRS approved custodian. You perform qualified transfer, and then that's what the difference is. A special purpose LLC is created. This is a single member LLC. The IRA is the member, not you. You're the manager of the LLC, and the IRA is the member of the LLC. And then as a manager of the LLC, essentially you control the LLC. You have the authority over what takes place inside of the LLC as a manager. As a manager, you will open a business checking account in the name of the LLC, instructing the custodian to fund the LLC. IRA buys units of the LLC, 100% of the units, and then funds are transferred from the IRA custodial account into the LLC bank's checking account. Well, once that takes place, you now in control. There is no more middleman, and you as a manager can decide how to invest, and you actually execute the investment. and that execution is as simple as writing a check. You can literally buy a property just by writing a check. All of the income and expenses going to and from the LLC checking account, and there is no cost for that, no transaction fees. The final option is what Vince mentioned, what we did for him, or what we did for my client Jason. It is a solo 401k. It is also known as the ultimate retirement plan, and you'll see why it is called that way after you'll see some of the benefits that it is offering. It is set up under Internal Revenue Code section 401 subsection K, and it is defined as a retirement savings trust. This particular plan, just as the name implies, solo, designed for solo owners or self-employed people or small business owners where business owner is the only employee. There is no other employees. It's not new type of plan. They essentially it's your 401k, but just covering business owners and the spouse. So spouse can also participate in the plan, and essentially by aiding your spouse, if your spouse is also employed in the business and receives compensation, then you can double the benefit. But increased interest in these plans really jumped up through the roof in 2002 as a result of changes in the tax law, which made these benefits available. I'll show them to you in the next couple slides. But this law changed many current benefits of the solo 401k and made them possible. But let's talk about eligibility. As I mentioned, it is not for everyone. You have to meet two criteria. Number one, you have to have a presence of self-employment activity. The self-employment activity can be in any type, shape, or form. Just a few examples. And number two is the absence of full-time employees. You can't have any employees working more than 500 hours a year for you. So just to give you a few examples, I have clients who are real estate agents, part-time or full-time. It doesn't matter, as long as you have legitimate activity, you're eligible. You still might have a W-2 job on this full-time and do something on the side. Or I have many clients who are actually flipping properties. They buy fixer-uppers, they improve them, and then they sell them for a profit. That's their side business. You can be a consultant or doing pretty much anything on the side. You can drive Uber or Lyft, once a quarter. Just generate some income that makes it legitimate. Or if you have a spare bedroom in your house, or if you have another property that you Airbnb, or doing any other type of short-term vacation rentals. The key is short-term, doesn't have to be vacation, the short-term. So the essentially short-term rentals, consider it business income or self-employed income. That will make you eligible. And even if you don't have any side business or a side gig, you can easily start something up. It just takes planning and maybe analyzing your situation a little bit, but you can certainly get that set up. So the only thing that will disqualify you from this is having a business with full-time employees. So let's see how it works.
Hey, Dimitri, really quick question.
Yes, sir.
You mentioned that short-term rentals constitutes as self-employment. Would a long-term rental constitute that as well, or is that disqualified?
No, long-term rental is passive.
Okay.
Rental income is passive income. So again, specifically short-term rentals, I believe if it's under 7 days on average, if you take if you're doing a short-term rentals, a few days or a week, few weeks perhaps. But if an average number of nights is, I believe, under 7, then that will be considered short-term, and that short-term rental income classified differently than long-term annual lease, for example. So that long-term lease is a passive income, but the short term is considered self-employed income subject to self-employment taxes.
Got it. Thank you.
So unfortunately, some people, it's a good question, Vince, but some people come to me and say, hey, I do have a business, real estate business. Well, tell me, what is it? Well, I have few rentals. Well, if it's, again, long-term rentals, they are passive income. So that's, from the IRS standpoint, those are investments, they're not considered a business. But there are ways to, even if you're managing them yourself, there is a potential of generating some self-employment income as of that, but that requires advanced planning with your CPA. All right, so back to the slide, how it works. First off, you must have a plan sponsor, and that sponsor is essentially a business. You can have an LLC, partnership, or a corporation, or you can be just a sole proprietor. Again, if you're a real estate agent, you work with a broker, but you do everything under your own name, and the income is reported to your social security number. That's how you get your 1099. You are a sole proprietor. If you're driving for a Lyft or Uber, you are a sole proprietor. You know, if you flipping a property, again, if you do it under your own name, you are a sole proprietor. So you, like I said, once you have that, you have the sponsor. Step 2, the solo 401k plan is established. The sponsor adopts the plan, and plan and trust are created. So in the case of a solo 401k, custodian is not required, unlike with an IRA. So with an IRA, you must have a custodian, a trust company. So with the solo 401k, custodian is not required. And instead of using a trust company, we creating a trust for the 401k plan. So solo 401k trust is established, and the trust is a separate entity. This entity will have its own unique name. It will have its own unique tax ID number assigned by the IRS, and you are designated as a plan trustee. As a plan trustee, you control the trust. Similarly, as a manager of the LLC, in a previous example, you control the LLC. Here, you control the trust as a trustee. Once it is established, then as a trustee, you will have the authority and power to open a business checking account in the name of the trust using a trust tax ID number. You can essentially open that at any financial institution or brokerage of your choice. And then as a trustee, you make the decision how to invest. And you can, again, decide to buy certain rental property. You can decide to fund a real estate note or a mortgage. All of the income is flowing back to the trust checking account, and all of the expenses paid from that. So again, the investment can be done as simple as writing a check. With the solo 401k, you write the check, you buy the property. Rental income going back into the account, and you, again, if there is any expense, you have a repair or a plumbing bill, you write the check, and or you can even use a debit card to pay the expenses. Well, let's talk about the benefits and why it is called the ultimate retirement plan. So take a look at that. Number one, it has a pretty high contribution limit. So for 2021, the contribution limit, the maximum you can put into this plan is $63,500. Now compare that with an IRA, which is $6,000. So nearly 10 times higher. It also has a loan feature allowing you to borrow from your 401k up to $50,000 or 50%, whichever is less, for any purpose. If you have an IRA and you need some cash, you've got a medical emergency or something, and you need some cash, there is no way you can tap into an IRA unless you take a distribution. And distribution is obviously a taxable event. If you take premature distribution, you will be penalized on top of that. So one example comes to mind is this client of mine. It's been years ago, but she actually was looking to, considering she had about $10,000 in medical debt, was high interest, and she was just struggling. All the payments were only covering interest, She wasn't paying any principal, so she actually was considering cashing out her IRA, and her CPA, after he ran the numbers, said you need to pull out about 20 grand so that you can end up with 10, because about 10 will have to pay the taxes and penalties. And then she discovered solo 401k. We spoke. She qualified for a solo 401k. That's what we did set up for her. She moved the money from an IRA, and then she took a loan, tax-free loan for 10 grand only. She used that 10 grand to pay off the interest. I'm sorry, the medical debt that she had, and now she began to pay payments and interest back to her own 401k. So it can be useful. It is there available, and you can use it for any reason. Next, Roth type contributions. With the solo 401k, you have the ability to make pre-tax contributions and get immediate tax benefit, tax deduction, or you can choose to actually contribute after tax into Roth. It works similar, just like a Roth IRA, but there is no income restriction. With Roth IRA, if you make over a certain threshold, you're not eligible to contribute. With solo 401k, regardless of your income, you can make a contribution. Next, it is very cost effective. It allows you to have a checkbook control. There is no custodian period. There is no need for the LLC. So all of those costs are eliminated, and it's very cost effective. As a trustee of the plan, you control it, and as I mentioned earlier, your spouse can participate as well. So if you and your spouse both in the business, both of you can participate, and you can double the benefits. You can, I mean, if each one of you contributed the max, 63 times 2, that's well over $120,000. If you're in business and you're doing well, and you're able to maximize your contributions, and you put over $100,000 of your income or shelter that much of your income into a retirement account, think about what it's going to do to your bottom line, how much money you're going to save on taxes. Now you immediately dropped your total taxable income by 100 grand plus. So you're paying taxes on a lower amount, and you most definitely will be in a lower tax bracket if you're able to drop your income that much. So you're going to be paying lower amount in a lower tax bracket. I mean, potentially $30,000+ in savings on taxes alone, and just using this strategy can be very, very powerful. So it's a great tax shelter. And last but not least, it is exempt from unrelated debt finance income, which is essentially if you use leveraged, if you have leveraged income, if you use leverage to acquire a property inside of an IRA, then there will be a tax on this income, on a portion of the income that is derived from the financed portion of the property. But 401k is exempt from this. So if you use leverage inside of a 401k to acquire rental property, there will be zero tax consequences. So just another reason to use Reddick and find some nice rentals and use leverage to increase your ROI and zero tax liability. Well, if you look at this picture, what happened here? Man holding a basket, and the bottom fell off, and all of his eggs are gone. Maybe he's able to salvage one egg yolk, possibly, but all the eggs are broken. So, and wife says, I thought that our investments were diversified. Well, guess what? If all of your investments are in one basket, they're not diversified. You need multiple baskets. And that's what the solo 401k provides you. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. We don't know what tomorrow may bring. Very wise words here. Diversification is very wise. And a true diversification can be accomplished with a self-directed IRA or 401k. I'm pretty much repeating myself, but these are just some of the investment options. You can invest in precious metals, residential real estate, multifamily. You can do hard money lending, invest in a private business, trust deeds, stocks, liens, and on and on and on. Well, let's talk about the limitations, what it is that you cannot do. Internal Revenue Code section 4975 says that you are not allowed to invest in collectibles with your IRA and life insurance contracts. And you cannot invest in the S corporation. Now, people get confused when they see that. If you own a business and it is an S corporation and you have no employees there, you can set up a solo 401k. You just cannot use the solo 401k to invest into another S corporation. You certainly can set up a solo 401k if you own S corp. But to invest in an S corp, you have to be a physical person. Shareholders are individuals. You can invest in the C corp. If it's still confusing, we can certainly talk to you about specifics, perhaps one-on-one. But those are the limitations. Other than that, you can invest in virtually anything. On top of that, the same section describes disqualified person, and disqualified person is essentially yourself and your immediate family members. And the easy way to remember that is a vertical line. Think vertically. And vertically is you and your spouse, your parents, grandparents, kids, grandkids, and their spouses. Okay, so horizontal actually, like your brother and your sister and your nephews and your uncle, those are not considered disqualified. So your 401k or IRA could do business with extended family members, but not immediate family members. And the prohibited transaction, basically any direct or indirect sell, exchange, or leasing of the property between a plan and disqualified person. So if your 401k owns the property, you cannot lease it to your daughter or to your parents. That will be a prohibited transaction because your daughter and your parents are disqualified person. There is no transaction allowed between a plan and disqualified person. Lending of money or extending credit between a plan and disqualified person. That's why when you use leverage, you can use leverage, but you cannot provide a personal guarantee for the loan to a 401k. Therefore, loan has to be non-recourse. Vince mentioned that Marsh Reddick offers those loans. So if you're using your IRA and you want to increase your ROI and use leverage, you can do that. And there are certainly lenders out there, including Marsh Reddick, and but it has to be non-recourse, meaning there is no personal guarantee. You're personally not responsible for the loan. Property is the only security for the loan. Providing goods or services or facilities between a plan and disqualified person. A good example of that can be if you're a real estate agent and you're buying a property in your 401k, you cannot act as an agent on that transaction. Acting as an agent will mean that you're actually providing services to the plan. That is not allowed, regardless whether you're getting paid or not. You're not allowed to provide services. You can't go into your into a property, rental property that your 401k owns and do any work on that property, any improvements. That is not allowed. You have to hire somebody who's unrelated to you. Transfer to or the use for the benefit of a disqualified person of the income or assets of the plan. So all the income that property generates must go back to the 401k. You can't use that personally. You are certainly, as the owner of the IRA or 401k, you can take a distribution subject to applicable taxes and penalties, but you can't use income of the plan directly for your own benefits. Or if you have a, let's say, vacation rental in your 401k, your family cannot stay in that property even a single night, regardless whether you pay in market rent or not. Staying in that property means that you're receiving benefits, and that is not allowed. And any act by a disqualified person who is a fiduciary where he deals with the income or assets of the plan in his own interest. And receiving any consideration for your own personal account by any disqualified person who is a fiduciary from any party dealing with the plan in connection with a transaction involving the income or assets of the plan. The bottom line is this. Remember those the vertical line, those immediate family members. You want to make sure that transaction that your IRA or 401k is involved is arm's length. And arm's length meaning that no disqualified person is part of that transaction in any way, directly or indirectly. As long as the transaction is arm's length, you're in good shape. And one thing that I always tell my clients, if you're not sure about something, ask. And ask me before doing this, not after. Vince is a good example. Vince actually just shared that he closed on a property and he had a question. He called and asked the question before the fact, not after. But I had other clients call me saying, hey, I did this and I did that, what do you think? Well, if you've done it, it's too late. It's too late to call me. So be sure to talk to me before, not after. Well, buying real estate inside of an IRA or 401k, pretty straightforward. Income and gains generated by the account are deferred from taxes. You pay tax at the future date rather than in the year the investment produces income. So you take advantage of the compound interest. Real estate income and gains inside of a Roth IRA or a Roth 401k are tax-free. And as I mentioned earlier, all the income must go back into the account, all of it, and all of the expenses must be paid from the account, all the expenses. You can't receive any income and deposit any income into your personal checking account from the property that your 401k owns. And likewise, you cannot pay any expenses for that property from your personal account. So you must have a separate set of books for your IRA or 401k. You can finance, as I mentioned, you cannot provide a personal guarantee on that loan. So it must be non-recourse. Property is the only security. Typically, you need 30 to 50% down. Property must cash flow. Lender will require that. You must have reserves. It will trigger UDFI. For an IRA, 401k is exempt from that. And there's only select banks and lenders who do that, including Marsh Reddick. Just a quick comparison side by side of the three options. All of them allow alternative investments. You need a custodian for an IRA, but not for the 401k. You get the checkbook control with the IRA LLC or a checkbook IRA and with the solo 401k. There is LLC fees with the IRA LLC. Depending on the state, it varies. Not with the 401k because it's set up as a trust. You can only borrow from the 401k, not possible. Loan is not possible with an IRA. UBIT on leveraged real estate, unrelated business income tax. With an IRA, 401k is exempt from that. Look at the max contribution again. That's why solo 401k is the ultimate plan, because it's a great tax shelter among other benefits. Solo 401k also offers built-in Roth, so you can have both pre-tax as well as post-tax contributions there. And solo 401k is not for everyone. You must be eligible for it. Business with no employees or self-employment. Well, it's been a lot of information that I squeezed in, and I felt like I was kind of flying, and you guys may have some questions. So I do offer complimentary consultation. You can just go to this link directly, or you can go to our website, sensefinancial.com. There is a link on the front page there as well. everybody will get complimentary 15 minutes consultation. Vince, we might have some time for questions, so if you can squeeze at least few questions, that will be great. I think you might have a couple more slides to cover, but thank you guys. Hope you found this information helpful, and Vince, take it over.
Yeah, that that was amazing. Thanks so much, Dimitri. So we do have a few questions coming in. So I want to try to get to as many as I can. Again, remember, guys, I will be doing follow-ups after this and putting you in touch with either, obviously myself or Dimitri to get these set up. But Dimitri, I will go ahead and kind of rattle off a few of these. Question that just came in: upon passing, can the solo 401k be transferred?
Sure, just like any other retirement account, you will designate a beneficiary when you set up the plan. So you can certainly select a beneficiary. You can put your spouse, you can put your kids, you can put your living trust as a beneficiary. Sure.
Awesome. Another question: can you roll over money from Roth 401k or IRA to a solo 401k?
You can roll over Roth 401k into a solo Roth 401k, but not the Roth IRA. Roth IRA can only go to another Roth IRA. IRS does not allow Roth 401k, Roth IRA to a 401k rollover.
Got it. As another question, what is UDFI, which is a term we were mentioning earlier?
Yeah, UDFI stands for Unrelated Debt Finance Income. And essentially, if you, let's say you have 100,000 in your IRA and you're looking to buy property for 200,000, you can do that. You can get a non-recourse loan, you can put $100,000 down, and you can get a loan for 100,000. So 200,000 combined. You have 50% LTV. So 50% of the property is financed. Well, in this case, if you use an IRA and you finance 50% of the purchase price, essentially half of the income comes from the leveraged portion of the property. So half of the income, you can still deduct half of the expenses, the property taxes, insurance, property management, any repairs, half of that, of those expenses can be deducted. But the remaining income will be subject to what's called a UBIT, unrelated business income tax. So UDFI, unrelated debt finance income, results in UBIT, unrelated business income tax. But that's only in an IRA. 401k is exempt from that.
Got it. Another question: if you use the solo 401k to buy rental property, do you suddenly become a holder of passive income, which makes you ineligible?
Okay, read that question again, please.
If you use the solo 401k to buy property, do you suddenly become a holder of passive income, which makes you ineligible?
Well, first of all, the only thing, as I said, that can make you ineligible is if you own a business with employees. If you own a business with employees, you're ineligible for solo 401k. Okay, and that's the only thing that can make you ineligible. Okay, if you're otherwise self-employed, or if you own a business without employees, you're eligible. And owning a rental property, passive or active, cannot make you ineligible. Okay, but the question here is buying a property in the 401k. That has nothing to do with your business. That's a 401k owned property. You don't own that property. It has nothing to do with your eligibility. It doesn't affect your eligibility.
Got it. Great. Thank you. We'll just do a couple quick ones. If my spouse is a sole proprietor, can I invest in her solo 401k with my W-2 income?
No, you cannot. Your W-2 income, if your employer offers a 401k, that's where you can contribute. You can also set up an IRA and contribute that. You can't take your W-2 income and contribute that to your spousal IRA. Just like your spouse can't contribute to your 401k. If you have a 401k at your job, it has nothing to do with your spouse. So if your spouse is self-employed, if it's a sole proprietor and it's just your spouse, you're not part of that. You cannot be part of the solo 401k. However, if your spouse owns a business, and it can be again in any shape, but if you are also involved in the business, let's say you are, your spouse flips properties, okay, and your spouse primarily involved in flipping, and you help your spouse. You maybe do the books, you do the perhaps some marketing and some other coordination, some office work. Well, then you participate in the business, and depending on how it is structured, you can also participate in the solo 401k. You just need to show that you're receiving income from the business as well. So if you are involved in the business and receiving income, you can participate and contribute to a solo 401k.
Got it. And then last one, can I move my 401k from previous employer into a solo 401k?
You sure can. Any previous employer 401ks or 403bs, any IRAs can be moved. The only thing that I'm going to repeat what I mentioned earlier is that if your 401k is with the current employer, the chances are you may not be able to move those funds. Although there could be exceptions, and it's worth checking with your employer, even if you have a current 401k, can you do, the keyword here is in-service distribution.
Got it. Awesome.
Great questions.
Yeah, those were great questions, and we're having a bunch more come in. So what we're going to do is, like I said, I'm going to be doing some follow-up. And, when I do follow up, it can go, for as long or as short as you want. Typically, where my role comes into is if you're interested in either exploring investments in that of real estate or that of, private lending, I can kind of go over those options. If they are going to be, involved in real estate, I just have a quick kind of outline of what our consultations look like. We want to go over the kind of the who, what, when, where, and why, right? Like, why are you buying real estate? How are we going to do this? Are we going to do it in your solo 401k, or are we going to do it in a traditional, savings account? When are you looking to do this? What kind of property? Where? And then obviously all the key players, as you guys, learned firsthand, Dimitri is a key player in this particular space if we're going to be using self-directed retirement accounts. So getting those set up is first. So, when I do make those calls, I'm more than happy to make transitions over to Dimitri for those consultations. And then we can always come back to myself for, any other kind of investments once that account is set up. So I will go ahead and share my contact information. But again, wanted to thank everybody for the time today. Again, Dimitri, awesome presentation. There was tons of valuable information. I know we're still getting good questions, so we'll be going over those, and feel free to reach out, guys. And we appreciate you joining us tonight.
Yeah, thanks for joining. You guys have a great rest of the evening.
Thank you. Bye-bye.